The man behind all of this, P.S. Jayakumar, MD and CEO of Bank of Baroda, joins us right now on the show to talk about what now for Bank of Baroda. Really good having you, Mr. Jayakumar. Thanks so much for joining in. And that's really the question, isn't it? Firstly, compliments on such a move. You took the market by surprise. Not too many people anticipated this, and which is why the reward to the stock. But the question that now comes to mind is, now what for a BOB?
I think it is back to usual. Businesses are built, banking businesses are built loan by loan, deposit by deposit. We'll keep focused and keep going forward. There are a lot of things to do from a perspective of bringing in different products, improving existing product sets. A lot of work to be done in the area of technology to make us leapfrog, at least reach the current level, and preferably leapfrog existing technology and service providers. There's a lot of work that we need to do on the corporate lending side, being more specific about the target market of customers we need to reach out to, rebalance our portfolio. There are certain inefficiencies in our balance sheet which we need to move out of. So on aggregate, a number of things to be done. Some will happen early, some will happen late, some will take more time. But the important thing is to stay focused and get it done.
I know you've shared this number with the analyst fraternity.
It's all about execution.
Okay, I want to also, clear the air on your current book value. You've shared the number with analyst on Saturday, but just for the benefit of our viewers, the calculation of book value, how have you arrived at your book value?
No, let me tell you what exactly has happened as far as the provisioning is concerned, and then the resulting NPA, which then takes you to the book value calculation. We have a slippage of about 15,000 odd crores happening in this quarter. A certain portion of it had happened because of the AQR review of the Reserve Bank of India, which I think contributed a little tad over 7,000 crores. These are accounts or customers who are paying perfectly on our book, but are probably in having stress with other banks. So in a sense, these provisions could have happened subsequent period of time, either this quarter or the next year. So that having been identified, certain amount of pressure is off, meaning we've identified proactively certain stress that might be in the book. That was one. Second, we also did a full review of our existing portfolio to see potentially places where NPA should have been accounted, but may not have been accounted for a variety of reasons. We completed that exercise. I wouldn't say completed, we substantially completed that exercise. We had a tad over 3,000 crores moving into NPA. We had some amount of amounts moving into the NPA from a restructured account, and the balance 3,000 odd crores was the slippages from what are called SMA2. Our overall provision in terms is around coverage is around 53-54%, giving that bulk of the assets on which we have taken provision are real assets, plants, machineries, many of them having been completed. We think the extent of provision we have taken at this point of time is reasonably adequate. So a overall provision of somewhere in the order of 6,400 crores were taken, and with that we think the book is currently rightly valued and therefore the book value computation comes from there. That's really what it is. So the important thing is to do our best to make sure that accounts that are NPA are actually reflected as such, and provisions that are required in respect of them are taken. Now,
could you share the number with us? What is the book value at currently?
I think I'll just come back to that in a minute. But what I'm trying to tell you is that the net worth of the company after adjustment is really the book value at this point of time. That's how you should look at it.
Just to stretch the points that you are making right now. Yeah, go ahead, please.
No, that's what I'm trying to say. What I was also trying to say is, listen, is this the end of the NPA problems? I think we cannot give a deterministic position on it. It's a range of probability. There could be a scenario when things could be far worse in the economy, and there could also be a situation when the economy is doing extremely well. And then there could be a set of intermediary position between the two of them. When we look at capital and when we look at net worth, we look at the worst position. What can go wrong from here and how much more things could get worse. Our analysis suggests that in the event of a scenario that the next year is not really, the next year the economic outcomes are not good, we still think there is enough earning power in the company to pay for additional amount of provisions that we may need to take on account of further flow that would happen in such an event. Keeping this in mind, I think it's reasonable to conclude, I think, that the reflected net worth of the company would be the book value of the company.
That's an interesting point you're making, Mr. Jayakumar. So you're not ruling out that the NPA situation could actually worsen. While you may be extremely well equipped to handle it, you do think that the economic situation could go worse from here and there would be a rise in NPAs thereafter as well.
Well, I'm not, let's again restate that position.
Sure.
I'm not here saying it's going to happen this way or it's going to happen that way. As an institution, we have to take into account considerations of a range of probability that could come through, and then we need to ask whether our shareholders and our customers are adequately, and depositor holders are adequately protected. That's the point I'm trying to make. So my point is, let's take the most negative outcome that you may think about. I think even in that point of time, I think we have and should be having enough earning flow to adequately stay protected as far as the NPA is concerned, and therefore further dilution of equity capital on account of the current NPA and the provisioning requirements should not happen. That broadly is the point I'm trying to say. Do we want the worst outcome to come? Absolutely not. Do we see it happening? Doesn't look like. But in any case, you have to plan for these various scenarios, various contingencies, and have a plan in respect of them. So you need a plan A, you need a plan B, you need a plan C.
So, go ahead.
No, I was just wondering on that same topic, since you're talking about the worst case scenario, would slippages revert back to the normal of 5 to 6 to 7,000 in the quarters ahead, while they showed that substantial jump in quarter 3?
Well, here is what, well, I would put it to you this way, that slippages of a substantial nature on account of lumpy accounts are not likely to happen. We don't see that happening. But we do have some amount of, exposure on account of the SMA2. We have factored all of that into account in looking at the next year's projection, in the range of scenarios we have. We are hoping that we will stay at the current level, but we cannot rule out things, deteriorating or things moving around. But even if they were to do, we have a set of plans to address and ensure that we're adequately protected from a capital perspective and enough capital to grow. So I don't want to be prophetic about what will happen. I can only talk about what it is today. Today I want to tell you that we have adequate provision and we have declared all that is an NPA as an NPA. Can there be additional flows? I don't see that happening from large accounts because we're reasonably well, all of that is reasonably done. The AQR to some extent is a reflection of that, so they've been brought forward, so it is there. On the retail side, deteriorations can happen, but I really don't worry about it because we are reasonably well collateralized, and historical loss rates in mortgage industry on a lifetime basis have been practically next to nothing. So that leaves us with a certain amount of discussion around the SME portfolio, and our focus therefore is to manage that very actively and ensure we take whatever risk mitigants that are done to prevent further deterioration in the portfolio. That really is what it is.
Thank you for articulating that. I'm still looking for that number, your book value number. According to your assessment.
What number do you want?
What is your current book value?
Yeah. Listen, I told you it must be theoretically the net worth of the company because all of it is provided for. And I think Mazamanus, we were at some 40,000 crores or thereabout when we started off. Now with the adjustment of 3,000 crores, we're at about 37,000 crores. Mazamanus. That would be the book value of the firm.
Now I'm going to shift the scope of the conversation. What we've discussed is bad news, NPAs, write-off. But your loans are collateralized by assets. So you have some underlying assets. B, assuming that economic recovery is round the corner, a little bit of recovery starts, bad loans will start becoming good loans. You've taken a write-off, but once you start recovering them, bad loans, they become good loans. How far are you away from A, asset recovery, and bad loans becoming good loan cycle?
So I think, I would factor in the good news a little later. Let us see that happening. But here is how the mathematics look, and you have to look at the mathematics around it. We have approximately give or take 38,000 crores of assets that are in the NPA category. Okay, we on an average on those classes of assets has provided approximately 40% by way of provision. So if we are able to move 5,000 crores from and where to get a flow back, an assumption that is reasonable to make today, the recovery on that would adequately protect us for the further deterioration that would happen on the balance of the portfolio, which would require us to take some additional provision by virtue of the accounting rules, etc. So net, when you take that portfolio, we are pretty much should be reasonably well protected, because the recoveries would pay also for the further deterioration. Hopefully, the net effect on the NPA is not significant. That is one part. The second part of the discussion, and I want to be candid with you, is that we have something like 17,000 odd crores on restructured asset, out of which 3,300 crores are thereabout or for various discom companies. We have done a variety of exercise with respect to the balance. We think the worst case is an 8,000 crore flow from the restructured account. So you take that forward, you have some number of provisioning that has to be taken on account. Take a number 30%, that adds up to about 2,400 crores thereabouts. And then we have the balance of SMA2. It is unreasonable to believe none of them will flow. There will be pluses and minuses, but there could be a net flow out. So I put all of these scenarios into picture. I ask people to look at what they would put as probability. And then we tell them that, listen, we have a revenue generation capability, pre-tax, pre-provision, which we have done in 2014-15 of about 9,800 crores or thereabouts. Assuming that we are doing all that we are planning to do in terms of improving the total quality of the earning, we probably should be there as a little bit further, hopefully a little bit less, maybe that's where it is. We have a fair amount of assets which we can liquidate, which we call as non-core. This does not include any investment in our subsidiaries. It does not include investment in the insurance company. These are investments that have been made over a period of time which do not carry any more strategic value, and the question is to exit and at the right value. So put all of these pluses and minuses, it seems to me that we are in a fairly comfortable position overall, which is why we took a position, we explained that we see a return to 5 to 8, from 6 to 12% return on equity, depending upon how the economic environment will eventually play out.
Looking for that answer,
and then we
sir,
said whatever be the economic environment that plays out as we go into the next year, which is 2017, 2016, 2017 to 2017, 2018,
right,
we should get back to a reasonable level of return on equity, which would be 14-15%. That really is the mathematics of it.
Okay. And I was looking for that answer, sir, that you're in a comfortable position.
And actually, with all our analysts,
yeah,
we have in fact taken them through simulation. We have put various scenarios and outcomes and said, if this happens, in this scenario, this happens. But really, when you talk to equity holders, they're really, at this point of time, concerned, first, foremost, about unlimited dilution, and second, about return to normality.
You answered both these questions.
So we tried to address the first issue.
And you've answered both these questions, Jayakumar, that you don't need capital or fresh capital, and you expect that in next 2-3 years things will come back to your mean averages. Appreciate your time. Good luck, sir. And let me tell you that markets are delighted.
Absolutely, that would be correct.
Okay, appreciate your time, sir. We got to leave it there. And let me just mark markets once again. Nifty from the day's highs off by about 14 points. So from the day's highs, it's a reversal of about 55-60 points. And what's making market nervous is that in this budget,